Market Wizards by Jack Schwager, book summary in English. Welcome to PowerBooks. Are you fascinated by the world of trading and investing? Do you want to learn from the best? Then you're in the right place. Here, we dissect the wisdom of legendary traders, exploring the strategies, discipline, and psychology that separate the winners from the rest. Inspired by Jack Schwager's Market Wizards, we delve into the minds of those who've conquered the markets. From trend-following masters to value investors, from floor traders to system developers, we uncover the secrets to consistent profitability. We'll break down complex concepts into actionable insights, helping you to refine your own approach and achieve your financial goals. Subscribe to PowerBooks and embark on a journey to master the art and science of trading. Let's unlock the power of market wisdom together. Chapter 1: Michael Marcus, Blighting Never Strikes Twice. This opening chapter introduces Michael Marcus, whose early trading career was marked by a significant and painful loss, the blighting. This experience, while devastating at the time, became a pivotal learning moment. Marcus emphasizes that while losses are inevitable in trading, making the same catastrophic mistake twice is avoidable through rigorous risk management and learning from past errors. The interview traces his journey from initial struggles to becoming a highly successful trader, highlighting the crucial role of mentorship, particularly from Jim Rogers and Bruce Kovner. Marcus underscores the importance of cutting losses quickly, controlling risk on every trade, and maintaining adaptability in the face of ever-changing market conditions. He also touches upon the development of intuition grounded in experience and knowledge. Key takeaways: the importance of learning from losses. Significant losses can be powerful teachers, preventing future, similar mistakes if the lessons are internalized. Blighting never strikes twice signifies not repeating critical errors. Cut losses quickly. This is a non-negotiable principle for survival and long-term success in trading. Hesitation can turn small losses into large portfolio-damaging ones. Rigorous risk management is paramount. Control the size of your positions and use stop-loss orders diligently to protect your capital. Every trade should have defined risk parameters. Mentorship can accelerate learning. Seeking guidance from experienced and successful traders can provide invaluable insights and shortcuts on the path to profitability. Adaptability is key. The market is dynamic. Traders must be willing to change their strategies and perspectives when the market signals they are wrong. Intuition develops from experience. While gut feelings alone are unreliable, seasoned traders develop a form of intuition based on patterns and accumulated knowledge. Chapter 2: Bruce Kovner, the World Trader. This chapter delves into the strategies and mindset of Bruce Kovner, a highly successful global macro trader. Kovner's early career included forays into academia and politics before he found his niche in the financial markets, starting with a $3,000 loan. A key lesson from an early trading experience, a significant loss after initial gains, instilled in him the importance of rigorous risk management. Kovner emphasizes the need for a well-defined trading plan, combining fundamental analysis with technical tools to identify and capitalize on market trends. He's known for his disciplined approach, particularly his focus on limiting risk and avoiding situations he doesn't fully understand. Kovner's success stems from his ability to stay rational under pressure, control his emotions, and adapt to changing market conditions. Key takeaways: risk management is paramount. Kovner's first rule is to avoid situations where you could lose a great deal of money for reasons you don't understand. He advocates for limiting risk to a small percentage of trading capital, around 1 to 2%. Undertrade. Kovner advises trading smaller positions than you might initially think appropriate. This reduces emotional stress and allows for greater flexibility. Combine fundamental and technical analysis. Kovner uses technical analysis to identify trends and entry-exit points, but always grounds his trades in a fundamental understanding of the market. Have a trading plan. A well-defined plan is crucial for consistent success. This includes predetermined stops and profit targets. Control your emotions. Successful traders remain rational and disciplined even under pressure. Avoid personalizing losses. Adaptability is key. Be willing to change your market view when the market indicates you are wrong. Chapter 3. Richard Dennis, a legend, retires. This chapter profiles Richard Dennis, a highly successful commodity trader known for his trend-following strategies and the famous turtle traders experiment. Dennis believed that successful trading could be taught, a hypothesis he tested by recruiting and training a group of novices with no prior trading experience. The interview delves into Dennis's core trading principles, emphasizing the importance of identifying and following trends, cutting losses quickly, letting winners run, and consistent position sizing. He discusses the simplicity of his core strategies, highlighting that discipline and adherence to the rules are far more critical than complex analysis. Despite his immense success, the chapter also touches upon his eventual semi-retirement, reflecting on the demanding nature of consistent trading. Key takeaways. Trend following can be highly profitable. Dennis was a strong proponent of identifying established trends and riding them for as long as possible. Cut losses short. Similar to other market wizards, Dennis stressed the absolute necessity of limiting losses on losing trades. Let winners run. Once a profitable trend is established, it's crucial to resist the urge to take profits too early and allow the winners to maximize their potential. Consistent position sizing is crucial. Properly sizing your trades relative to your capital and risk tolerance is essential for long-term survival and consistent returns. Trading principles can be simple. Dennis's strategies were based on straightforward rules. The challenge lies in the discipline to consistently follow them. Discipline over complexity, emotional control, and adherence to a well-defined system are more important than intricate analytical techniques. Even legends can step back. The demands of consistently trading at a high level can lead to burnout, highlighting the importance of understanding one's own limits. Chapter 4. Paul Tudor Jones, The Art of Aggressive Trading. This chapter profiles Paul Tudor Jones, a highly successful and influential macro trader known for his aggressive yet disciplined approach. Jones emphasizes the importance of flexibility and adapting one's trading style to different market environments. He highlights the need for strong risk control, even within an aggressive framework, stressing the preservation of capital as paramount. The interview explores his ability to take large, concentrated positions when he has high conviction, but also his willingness to quickly reverse course when proven wrong. Jones underscores the significance of intuition and a feel for the market, developed through experience and constant observation. He also touches upon the psychological aspects of trading, including the need for self-awareness and managing emotional biases. Key takeaways. Aggressive trading requires strong risk control. While Jones is known for taking large positions, he pairs this with a strict focus on limiting potential losses. Capital preservation remains the top priority. Flexibility and adaptability are crucial. Jones emphasizes the need to adjust trading strategies and position sizing based on changing market dynamics. Being rigid can be detrimental. High conviction trading. When a trader has strong conviction in a setup, taking larger, concentrated positions can lead to significant gains, but this must be balanced with risk management. Quickly reverse losing positions. Being able to admit when you're wrong and reverse a trade without hesitation is a hallmark of successful aggressive trading. Ego has no place in the market. Develop market intuition. Experience and constant observation can lead to a feel for the market that complements analytical approaches. Psychological fortitude is essential. Managing emotions, particularly fear and greed, and maintaining self-awareness are critical for navigating the pressures of aggressive trading. Chapter 5. Yes, they do trade T-bonds in Peoria. This chapter profiles Gary Bielfeldt, a successful trader who found his niche trading treasury bonds from an unlikely location, Peoria, Illinois. Bielfeldt's story emphasizes that geographical location is no barrier to trading success in today's interconnected markets. His approach is characterized by meticulous preparation, in-depth understanding of market fundamentals, particularly interest rates and economic indicators, and a patient, disciplined execution style. He highlights the importance of having a well-defined trading plan and sticking to it, avoiding impulsive decisions. Bielfeldt also underscores the value of continuous learning and adapting to the nuances of the bond market. His success demonstrates that focus, diligence, and a solid understanding of the specific market being traded are more crucial than being in a major financial center. Key takeaways. Location is no barrier to trading success. With modern technology, traders can be successful from anywhere in the world as long as they have the right tools and dedication. Thorough preparation and understanding are key. Bielfeldt emphasizes the need for in-depth knowledge of the specific market being traded, including its fundamentals and the factors that drive price movements. Patience and discipline are essential. Waiting for the right opportunities and sticking to a well-defined trading plan are crucial for consistent profitability. Avoid chasing trades or deviating from your strategy based on emotion. Continuous learning and adaptation. The markets are constantly evolving, so traders must remain committed to learning and adapting their strategies as needed. Focus on your niche. Bielfeldt found success by specializing in treasury bonds and developing a deep understanding of that specific market. Focusing your efforts can lead to expertise. Avoid impulsive decisions. Emotional trading based on fear or greed can be detrimental. Stick to your plan and execute trades based on your analysis. Chapter 6. Everybody Gets What They Want. This chapter profiles Seykota, a pioneer in computerized trading systems and a remarkably successful trend follower. Seykota emphasizes the power of simple, robust trading rules and the critical importance of self-awareness and accepting personal responsibility for trading outcomes. His famous quote, "Everybody gets what they want," suggests that our trading results are a reflection of our inner selves, including our beliefs, fears, and desires. The interview explores his systematic approach to trading, focusing on letting trends run and cutting losses short, often using simple moving average crossovers. Seykota stresses the need for traders to understand their own psychology and how it influences their trading decisions. He advocates for a detached, almost mechanical approach to executing trading signals, minimizing emotional interference. Key takeaways. Trading systems can be highly effective. Seykota's success demonstrates the power of well-designed, rules-based trading systems, particularly trend-following approaches. Simplicity often outperforms complexity. His trading rules are often straightforward, highlighting that the edge lies in consistent application rather than intricate analysis. Self-awareness and personal responsibility are crucial. Understanding your own psychological biases and taking full responsibility for your trading results is fundamental to improvement. Everybody gets what they want implies that our outcomes reflect our internal state. Let trends run and cut losses short. This classic trading adage is central to Seykota's philosophy. Maximizing gains during winning trends and minimizing losses is key to profitability. Minimize emotional interference. Successful trading often requires a detached, almost mechanical execution of trading signals, avoiding emotional decision-making. Trust your system. Once a robust system is developed and tested, it's essential to have the discipline to follow its signals without second-guessing. Chapter 7. Larry Hite, Respect Risk. This chapter profiles Larry Hite, a highly successful and outspoken trader known for his systematic, risk-averse approach to the markets. Hite's central philosophy revolves around the paramount importance of risk management. He emphasizes that survival in the long run depends on protecting capital above all else. His trading strategies are typically based on simple, robust trend-following systems with clearly defined rules for entry, exit, and position sizing. Hite stresses the need to diversify across different markets and to never risk a substantial portion of capital on any single trade. He advocates for a probabilistic mindset, understanding that losses are an inevitable part of trading and that the key is to keep them small and manageable. His interview is filled with practical wisdom and a no-nonsense perspective on the realities of trading. Key takeaways. Risk management is the top priority. Hite's entire approach is built on the principle of respecting risk. Protecting capital is the foundation of long-term success. Diversification reduces overall risk. Trading across a variety of uncorrelated markets can help to smooth out returns and reduce the impact of losses in any single market. Small, consistent losses are acceptable. Catastrophic losses are not. Hite views small losses as the cost of doing business. The goal is to avoid the large account-killing losses. Simple, robust systems can be highly effective. Complex analysis is not necessary for success. Well-defined, rules-based systems can capture profitable trends while managing risk. Probabilistic thinking is essential. Understand that trading involves probabilities, and not every trade will be a winner. Focus on having a positive expectancy over the long run. Never risk a significant portion of capital on one trade. Proper position sizing is crucial to ensure that a losing trade doesn't have a major impact on your overall capital. Mostly stocks. Chapter 8, Michael Steinhardt, The Concept of Variant Perception. This chapter profiles Michael Steinhardt, a highly successful and influential hedge fund manager known for his intense focus, intellectual rigor, and exceptional long-term track record. Steinhardt's core philosophy revolves around the concept of variant perception, the ability to hold a well-reasoned view of a situation that differs from the market consensus and to profit when that perception proves correct. The interview delves into his meticulous research process, his willingness to take contrarian positions, and his emphasis on understanding the underlying fundamentals of businesses. Steinhardt highlights the importance of intellectual honesty, being willing to change one's mind when the evidence suggests it, and having the conviction to act decisively when an edge is identified. He also touches upon the demanding nature of consistently outperforming the market and the psychological fortitude required to withstand periods of being out of step with the crowd. Key takeaways. The power of variant perception. Successful investing and trading often involve developing a unique and well-supported view that diverges from the prevailing market sentiment. Meticulous research is essential. Forming a variant perception requires deep and thorough research into the fundamentals of the asset being considered. Be willing to take contrarian positions. Profitable opportunities often arise when the majority is wrong. Having the courage to go against the crowd with strong reasoning can be rewarding. Intellectual honesty and flexibility. Be open to new information and willing to change your thesis if the facts no longer support it. Avoid being married to your initial idea. Conviction and decisiveness. Once a well-researched and differentiated view is formed, having the conviction to act decisively and allocate capital accordingly is crucial. Psychological resilience is necessary. Holding a variant perception can be lonely and challenging, especially during periods when the market moves against you. Maintaining conviction requires mental toughness. Chapter 9, William O'Neill, The Art of Stock Selection. This chapter profiles William O'Neill, the founder of Investors Business Daily, IBD, and the creator of the CAN-SLIM investment methodology. O'Neill emphasizes a systematic approach to identifying high-growth stocks with the potential for significant price appreciation. His methodology combines fundamental and technical analysis, focusing on factors like current quarterly earnings growth, annual earnings growth, new products or management, supply and demand, leading stocks in leading industries, institutional sponsorship, and market direction. The interview delves into each component of the CAN-SLIM criteria, highlighting the importance of identifying companies with strong earnings momentum, innovative products or services, and significant institutional support within favorable industry groups and an overall positive market environment. O'Neill stresses the need for investors to be disciplined, cut losses quickly, and take profits according to a predefined plan. Key takeaways. CAN-SLIM is a powerful growth stock selection methodology. Understanding and applying the CAN-SLIM criteria can help investors identify stocks with high growth potential. Earnings growth is paramount. Focus on companies with strong current and annual earnings growth, demonstrating increasing profitability. New products, new management, new highs. Look for companies with innovative offerings, positive changes in leadership, and stocks making new price highs, indicating strength. Supply and demand dynamics matter. Analyze trading volume and the number of outstanding shares to understand the supply and demand balance for a stock. Leading stocks in leading industries. Invest in the top-performing companies within the strongest sectors of the market. Institutional sponsorship is important. Look for stocks with increasing ownership by high-performing institutional investors. Market direction influences individual stocks. The overall trend of the market significantly impacts the performance of individual stocks. Invest in sync with the market's direction. Discipline in buying and selling is crucial. Adhere to strict rules for when to buy, when to cut losses, and when to take profits. Chapter 10. David Ryan, Stock Investment as a Treasure Hunt. This chapter profiles David Ryan, a three-time U.S. investing championship winner who learned and applied William O'Neill's CAN-SLIM methodology with remarkable success. Ryan views stock investing as an exciting treasure hunt where diligent research can uncover hidden gems, high-growth companies with significant potential. The interview reinforces the core principles of CAN-SLIM, emphasizing the importance of strong earnings and sales growth, leadership within its sector, a small float, and timely buying points after constructive price bases. Ryan shares practical insights on how to identify these characteristics in potential investments, stressing the need for patience, thorough analysis of charts and fundamentals, and the discipline to act decisively when the right opportunities arise. He also highlights the importance of continuous learning and adapting to evolving market conditions. Key takeaways. Reinforcement of CAN-SLIM principles. Ryan's success further validates the effectiveness of William O'Neill's CAN-SLIM methodology for identifying winning growth stocks. Stock research as a treasure hunt. Approach stock analysis with enthusiasm and a detective-like mindset, seeking out companies with compelling growth stories and strong fundamentals. Focus on earnings and sales growth. Look for companies exhibiting significant increases in both earnings per share and revenue, indicating strong business momentum. Identify leadership stocks. Invest in companies that are leaders within their respective industries, demonstrating innovation and market dominance. Small float can lead to big moves. Stocks with a limited number of shares available for trading can experience significant price appreciation when demand increases. Mastering buying points. Recognize and capitalize on constructive chart patterns, bases, that offer low-risk entry points for potential breakouts. Patience and discipline are key to execution. Wait for the right setups and adhere to your buying and selling rules without emotional interference. Continuous learning and adaptation. The market is dynamic, so it's crucial to stay informed, refine your strategies, and adapt to new market realities. Chapter 10. David Ryan, Stock Investment as a Treasure Hunt. This chapter profiles David Ryan, a three-time U.S. investing championship winner who learned and applied William O'Neill's CAN-SLIM methodology with remarkable success. Ryan views stock investing as an exciting treasure hunt where diligent research can uncover hidden gems, high-growth companies with significant potential. The interview reinforces the core principles of CAN-SLIM, emphasizing the importance of strong earnings and sales growth, leadership within its sector, a small float, and timely buying points after constructive price bases. Ryan shares practical insights on how to identify these characteristics in potential investments, stressing the need for patience, thorough analysis of charts and fundamentals, and the discipline to act decisively when the right opportunities arise. He also highlights the importance of continuous learning and adapting to evolving market conditions. Reinforcement of CAN-SLIM principles. Ryan's success further validates the effectiveness of William O'Neill's CAN-SLIM methodology for identifying winning growth stocks. Stock research as a treasure hunt. Approach stock analysis with enthusiasm and a detective-like mindset, seeking out companies with compelling growth stories and strong fundamentals. Focus on earnings and sales growth. Look for companies exhibiting significant increases in both earnings per share and revenue, indicating strong business momentum. Identify leadership stocks. Invest in companies that are leaders within their respective industries, demonstrating innovation and market dominance. Small float can lead to big moves. Stocks with a limited number of shares available for trading can experience significant price appreciation when demand increases. Mastering buying points. Recognize and capitalize on constructive chart patterns, bases, that offer low-risk entry points for potential breakouts. Patience and discipline are key to execution. Wait for the right setups and adhere to your buying and selling rules without emotional interference. Continuous learning and adaptation. The market is dynamic, so it's crucial to stay informed, refine your strategies, and adapt to new market realities. Chapter 11. Marty Schwartz, Champion Trader. This chapter profiles Marty Schwartz, a self-made trading champion known for his intense focus, adaptability, and remarkable track record in various trading competitions and the real world. Schwartz emphasizes the importance of knowing oneself and finding a trading style that aligns with one's personality and risk tolerance. He highlights his own evolution as a trader, learning from early mistakes and continuously refining his strategies. The interview delves into his disciplined approach to risk management, his focus on identifying and capitalizing on short-term trends, and his willingness to change his mind quickly when a trade isn't working. Schwartz underscores the psychological aspects of trading, stressing the need for confidence, emotional control, and the ability to handle both winning and losing streaks. His story is one of perseverance, continuous improvement, and the drive to be a top performer. Key takeaways. Know thyself and find your style. Successful trading requires understanding your own personality, strengths, weaknesses, and risk tolerance to develop a compatible trading approach. Continuous learning and adaptation. The market is ever-changing, and successful traders are constantly learning, evolving, and adapting their strategies. Disciplined risk management is crucial. Protecting capital through well-defined stop-loss orders and position sizing is paramount for long-term survival and profitability. Focus on short-term trends. Schwartz found success in identifying and capitalizing on shorter-term market movements. Different traders can find their edge in various time frames. Be willing to change your mind quickly. Don't get attached to a losing trade. The ability to admit when you're wrong and exit promptly is a hallmark of successful traders. Confidence and emotional control. Maintaining confidence in your system and managing emotions like fear and greed are essential for consistent execution. Handle winning and losing streaks. Avoid becoming overly euphoric after wins or overly discouraged after losses. Maintain a balanced perspective. Perseverance and determination. Achieving consistent success in trading often requires significant effort, resilience in the face of setbacks, and an unwavering commitment to improvement. A little bit of everything. Chapter 12, James B. Rogers, Jr., Buying Value and Selling Hysteria. This chapter profiles James B. Rogers, Jr., a legendary investor and co-founder of the Quantum Fund with George Soros. Rogers emphasizes a long-term, value-oriented investment approach, focusing on identifying undervalued assets and patiently waiting for their true worth to be recognized by the market. He is known for his deep understanding of global economics, commodities, and emerging markets. Rogers advocates for independent thinking and going against the crowd, particularly during periods of market euphoria or panic. His philosophy of buying value and selling hysteria underscores the importance of contrarian investing, buying assets when they are cheap and out of favor, and selling when irrational exuberance drives prices to unsustainable levels. The interview highlights his global perspective and his ability to identify long-term trends and undervalued sectors by looking beyond conventional wisdom. Key takeaways. Long-term value investing. Rogers champions a patient, long-term approach focused on buying undervalued assets with strong fundamental potential. Contrarian investing. He stresses the importance of going against the prevailing market sentiment, buying when others are selling, and selling when others are buying, especially during extremes of emotion. Deep understanding of fundamentals and global economics. Successful value investing requires a thorough understanding of the underlying businesses, industries, and macroeconomic trends that will drive long-term value. Independent thinking is crucial. Avoid blindly following the herd. Develop your own well-reasoned investment theses based on your own research. Patience is a virtue. Value investing often requires holding assets for extended periods, while waiting for the market to recognize their true worth. Identify long-term trends. Focus on significant, long-lasting trends that will create sustained demand and value in specific sectors or regions. Look globally for opportunities. Don't limit your investment universe to domestic markets. Global opportunities often present compelling value. Chapter 13, Mark Weinstein, High Percentage Trader. This chapter profiles Mark Weinstein, a trader focused on achieving a high win rate through meticulous planning, selective trade entry, and tight risk control. Weinstein emphasizes the importance of waiting for only the highest probability setups that align with his predefined criteria. He stresses the need for patience and avoiding the temptation to overtrade. The interview delves into his systematic approach, which often involves identifying specific chart patterns and waiting for precise entry triggers. Weinstein highlights the critical role of setting realistic profit targets and adhering strictly to stop-loss orders to protect capital. His philosophy centers on quality over quantity, aiming for fewer trades with a higher likelihood of success. He also underscores the psychological benefits of a high win rate in maintaining confidence and discipline. Key takeaways. Focus on high probability setups. Weinstein advocates for being highly selective and only taking trades that meet stringent criteria, increasing the likelihood of success. Patience is key to selective trading. Waiting for the right opportunities is crucial. Avoid impulsive trades driven by boredom or the fear of missing out. Meticulous planning and entry. Define your entry rules precisely based on technical analysis and wait for those exact conditions to be met. Tight risk control is essential. Use tight stop-loss orders to limit potential losses on each trade, protecting your capital effectively. Set realistic profit targets. Have clear objectives for each trade and take profits when those targets are reached, avoiding the greed that can lead to giving back gains. Quality over quantity. Fewer well-planned and high-probability trades are often more profitable and less stressful than frequent, less certain trades. Psychological benefits of a high win rate. Consistent winners, even if smaller, can build confidence and make it easier to adhere to your trading plan. Part 4, The View from the Floor. Chapter 14, Brian Gelber, Broker turned Trader. This chapter profiles Brian Gelber, who transitioned from being a broker executing orders for clients to becoming a successful, independent trader on the exchange floor. Gelber's experience provides insights into the dynamics of the trading floor, the importance of understanding order flow, and the development of a feel for the market through direct interaction. The interview highlights his initial challenges in making the switch and the learning curve involved in trading his own capital. Gelber emphasizes the need for discipline, quick decision-making, and the ability to adapt to the fast-paced and often volatile environment of the trading floor. He also discusses the psychological pressures of trading and the importance of maintaining composure under pressure. His story illustrates how first-hand experience and observation of market participants can contribute to a trader's education and success. Key takeaways. Understanding order flow is advantageous. Direct experience on the trading floor provides a unique perspective on how orders are executed and the underlying supply and demand dynamics. Developing a feel for the market. Constant interaction with other traders and the immediate price action can lead to an intuitive understanding of market sentiment. Discipline and quick decision-making are crucial. The fast-paced nature of floor trading demands the ability to make swift and disciplined decisions. Hesitation can be costly. Adaptability to volatility. Floor traders must be able to navigate and profit from rapid price swings and changing market conditions. Psychological composure under pressure. The intense environment of the trading floor requires maintaining emotional control and avoiding impulsive reactions. Learning from experience. Gelber's journey highlights the value of practical, first-hand experience in developing trading skills. Transitioning roles requires adjustment. Moving from a service role, broker, to a principal role, trader, involves a significant shift in mindset and responsibilities. Chapter 15, Tom Baldwin, the Fearless Pit Trader. This chapter profiles Tom Baldwin, a legendary pit trader known for his aggressive style, mental toughness, and ability to thrive in the chaotic and high-pressure environment of the trading pit. Baldwin's success stemmed from his deep understanding of market psychology, his intuition developed through years of experience, and his unwavering confidence. The interview highlights his fearlessness in taking large positions and his ability to quickly assess and react to the ever-shifting dynamics within the pit. Baldwin emphasizes the importance of having a strong mental game, the ability to handle losses without becoming discouraged, and the necessity of maintaining focus amidst the noise and intensity of the trading floor. His story embodies the raw, instinctual side of trading and the psychological fortitude required to consistently succeed in that demanding arena. Key takeaways: mastery of market psychology. Baldwin's success was deeply rooted in his understanding of how emotions and herd behavior influenced price movements within the pit. Intuition developed through experience. Years of immersion in the trading environment honed his instincts and allowed him to anticipate market turns. Fearlessness in taking positions. Baldwin was known for his willingness to take large, concentrated bets when he had conviction. Mental toughness and resilience. The ability to withstand pressure, bounce back from losses, and maintain focus were critical to his longevity and success. Quick assessment and reaction. The fast-paced nature of pit trading demanded the ability to analyze situations rapidly and execute decisions without hesitation. Confidence is key. Baldwin's unwavering self-belief contributed significantly to his ability to take bold actions and succeed. The unique dynamics of pit trading. While floor trading has evolved, the chapter offers valuable insights into the human element and psychological warfare that characterized that era. Chapter 16, Tony Saliba, One-Lot Triumphs. This chapter profiles Tony Saliba, a successful options trader who initially made a name for himself by focusing on trading single contracts, one-lots, with exceptional precision and risk control. Saliba's story emphasizes that significant profits can be generated through disciplined, high-probability trading, even with small position sizes. The interview delves into his meticulous approach to understanding options pricing, volatility, and the nuances of market microstructure. He highlights the importance of patience, waiting for optimal entry points, and managing risk on every single trade. Saliba's philosophy underscores that consistency and a focus on minimizing losses on each individual trade can lead to substantial cumulative gains over time. His success challenges the notion that one must trade large volumes to achieve significant results. Key takeaways: precision and patience. Over size. Saliba's one-lot triumphs philosophy demonstrates that focusing on high-probability setups and precise execution can be more effective than large speculative positions. Deep understanding of options. Success in options trading requires a thorough grasp of pricing models, volatility dynamics, and the various factors that influence option values. Meticulous risk management on every trade. Even with small positions, controlling risk through defined stop losses and position sizing is crucial. Wait for optimal entry points. Patience is key to entering trades at the most advantageous prices, maximizing potential gains and minimizing risk. Consistency leads to cumulative gains. Small, consistent profits, when managed effectively, can compound into significant returns over time. Focus on minimizing losses. By keeping losses small on each trade, the overall impact on capital is reduced, allowing for greater longevity and the ability to capitalize on future opportunities. Challenges the go big or go home mentality. Saliba's approach offers an alternative perspective, showing that steady, controlled trading can lead to substantial success. Part 4 of The Psychology of Trading. Chapter 17, Dr. Van K. Tharp, The Psychology of Trading. This pivotal chapter shifts the focus to the inner game of trading, featuring Dr. Van K. Tharp, a leading expert in trading psychology. Tharp emphasizes that while trading strategies and systems are important, a trader's mindset and psychological makeup are the most significant determinants of long-term success. The interview delves into key psychological principles, including the importance of understanding your beliefs about money and trading, managing fear and greed, developing self-discipline, and taking full responsibility for your trading results. Tharp introduces concepts like mental rehearsal, identifying and modifying limiting beliefs, and the significance of having well-defined trading rules and sticking to them. He underscores that consistent profitability is less about finding the holy grail strategy and more about mastering your own psychology. Key takeaways. Psychology is the key determinant of trading success. Your mindset and emotional control are more critical than any specific trading system. Understand your beliefs about money and trading. Unconscious beliefs can significantly impact your trading decisions and outcomes. Identifying and addressing limiting beliefs is crucial. Manage fear and greed effectively. These powerful emotions can lead to irrational decisions. Developing strategies to control them is essential. Cultivate self-discipline. Adhering to your trading plan, including entry and exit rules, and resisting impulsive actions are hallmarks of successful traders. Take 100% responsibility for your trading results. Avoid blaming the market or external factors. Own your decisions and learn from your mistakes. Develop well-defined trading rules and stick to them. A clear and documented trading plan provides a framework for disciplined decision-making. Mental rehearsal enhances performance. Mentally practicing successful trading scenarios can build confidence and improve execution. Focus on process, not just outcomes. Emphasize consistent adherence to your trading plan rather than solely focusing on individual trade results. Continuous self-assessment and improvement. Regularly review your trading performance and psychological state to identify areas for growth. Additional Section 1, The Trade, A Personal Experience, Jack D. Schwager. In this section, Jack Schwager steps out from the interviewer's role and shares a personal trading experience, often one that involved a significant learning moment or highlighted key trading principles. The specific details of the trade, market, time frame, strategy, and outcome will vary depending on the addition of market wizards, but the underlying purpose is to illustrate the practical application of the concepts discussed throughout the book. Schwager typically reflects on his thought process, the challenges he faced, both technical and psychological, and the lessons he ultimately learned from the experience. This section provides a relatable perspective, showing that even the interviewer and author of this seminal work has navigated the complexities and emotional roller coaster of trading firsthand. It underscores that the principles discussed by the market wizards are not just abstract theories, but have real-world implications and applications. Key takeaways, general specifics depend on the trade recounted. Real-world application of trading principles. Schwager's personal anecdote demonstrates how the strategies and psychological insights shared by the market wizards play out in actual trading scenarios. The importance of adhering to one's own rules. The story often highlights the consequences of deviating from a well-defined trading plan or the benefits of sticking to it. Psychological challenges faced by all traders. Even experienced traders grapple with emotions like fear, greed, and doubt. Schwager's experience can make these struggles more relatable to the audience. Learning from mistakes is essential. The trade recounted may involve a mistake or a loss, emphasizing that errors are part of the learning process and crucial for growth. The need for self-reflection. Schwager's analysis of his own trade underscores the importance of reviewing and learning from both winning and losing experiences. Illustrates specific trading concepts. The anecdote might highlight the importance of risk management, position sizing, patience, or cutting losses short in a practical context. Additional Section 2, Postscript, Dreams and Trading. In this reflective postscript, Jack D. Schwager delves into the deeper motivations and aspirations that often drive individuals to the challenging pursuit of trading. He explores the dreams that underlie the desire for financial independence, the thrill of intellectual challenge, the allure of mastering a difficult skill, and the potential for significant wealth creation. Schwager examines how these dreams can both fuel ambition and create unrealistic expectations or emotional pitfalls for traders. He emphasizes the importance of aligning one's dreams with the realities of the market, understanding the hard work and discipline required for success, and avoiding the trap of viewing trading as a quick path to easy riches. The postscript serves as a thoughtful conclusion, reminding readers that while the rewards of successful trading can be substantial, they are typically earned through dedication, perseverance, and a realistic understanding of both the markets and oneself. Key takeaways: understanding your underlying motivations. Recognize the dreams that draw you to trading. Are they realistic and sustainable? Balancing dreams with market realities. Avoid letting idealized visions overshadow the hard work, risk, and discipline required for success. Trading is not a get-rich-quick scheme. Be wary of the illusion of easy money. Consistent profitability typically requires significant effort and time. The importance of realistic expectations. Understand the probabilities involved in trading and avoid setting unattainable goals that can lead to frustration and poor decision-making. The role of passion and perseverance. While realism is crucial, a genuine passion for the markets and the determination to overcome challenges are essential for long-term success. Aligning dreams with your trading style. Ensure that your aspirations are compatible with the type of trading you pursue and your risk tolerance. The journey is as important as the destination. Appreciate the process of learning and growth in trading rather than solely focusing on the financial outcome. Additional Section 3, Final Word. In the final word, Jack D. Schwager typically offers his concluding thoughts and synthesizes the key lessons learned from his extensive interviews with the market wizards. He often reiterates the common threads that run through the approaches of these diverse and highly successful traders, emphasizing that while their strategies may vary, certain fundamental principles are consistently present. These often include the paramount importance of risk management, the necessity of discipline and a well-defined trading plan, the crucial role of understanding and managing one's own psychology, and the need for adaptability in the ever-changing markets. Schwager's final words serve as a powerful summary, reinforcing the core message of the book. Consistent success in trading is achievable, but it requires a combination of sound methodology, unwavering discipline, and a deep understanding of both the markets and oneself. Key takeaways. Reinforcement of core principles. Schwager reiterates the most critical lessons gleaned from the market wizards, providing a concise summary for the reader-viewer. Common threads among successful traders. Despite diverse strategies, certain fundamental principles like risk management, discipline, and psychological control are universally shared. The importance of a personalized approach. While core principles are constant, the specific strategies and techniques must be adapted to the individual trader's strengths and preferences. Trading is a skill that can be learned. The success of the market wizards demonstrates that consistent profitability is attainable through dedication, learning, and the application of sound principles. Continuous learning and adaptation are essential. The markets are dynamic, requiring traders to remain lifelong learners and be willing to adjust their approaches as needed. Focus on the process, not just the outcome. Emphasize consistent execution of a sound trading plan over the pursuit of individual winning trades. A call to action for aspiring traders. Schwager's final words often serve as encouragement and a guidepost for those seeking success in the challenging world of trading. Additional Section 4, What I Believe 22 Years Later, Jack D. Schwager. In this reflective update, written years after the original Market Wizards, Jack D. Schwager revisits the core principles discussed in the book and shares his evolved perspectives based on his continued observation of the markets and successful traders. He often reaffirms the timeless importance of risk management, discipline, and psychology. However, he might also offer nuanced insights gained over the intervening years, perhaps highlighting the increasing role of technology, the persistence of certain market behaviors, or any shifts in his own understanding of what truly drives trading success. This section provides a valuable long-term perspective, showing which lessons have stood the test of time and offering any updated thoughts from the author based on his ongoing experience. Key takeaways. Reaffirmation of timeless principles. Schwager likely reiterates the enduring importance of risk control, disciplined execution, and understanding trading psychology. Evolution of perspective. He might offer new insights or emphasize certain aspects of trading more strongly based on his observations over the subsequent 2 decades. The impact of market changes. Schwager might comment on how the markets have evolved, e.g., increased automation, globalization, and how these changes affect trading. Persistence of human behavior. He might also note the consistent role of human emotions and biases in driving market cycles and creating opportunities. Long-term validation of key lessons. This section provides a sense of how the principles discussed by the original market wizards have held up over a significant period. Potential new emphases. Schwager might highlight aspects that he believes have become even more critical in the modern trading environment. A continuing journey of learning. The update underscores that even for experienced market observers, the process of learning and refining one's understanding never truly ends. And that brings another insightful exploration of trading wisdom, inspired by Jack Schwager's Market Wizards, to a close. We hope you're taking away valuable lessons from the experiences of these legendary traders. If you found this video helpful, please give it a like. Share it with anyone you know who's passionate about trading and investing. We'd love to hear your thoughts. What's your biggest takeaway from the Market Wizards? Let us know in the comments below. To stay updated on our ongoing journey through the minds of the world's top traders, be sure to hit that notification bell. We're constantly uncovering the secrets to success in the markets. If you're eager to unlock the full potential of Market Wizards and absorb every lesson from these remarkable individuals, you can find a link to purchase the complete book in the description below. It's a treasure trove of invaluable insights. Thanks for joining us on PowerBooks. Keep learning, keep growing, and we'll see you in the next video as we continue to explore the wisdom of the Market Wizards.